You're listening to the Financial Source podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Deep Dive. So our mission today, well, it's a bit different. We're looking at global markets where the usual U.S. signals are pretty quiet.
Yeah, the Fed's in its blackout period, and getting fresh U.S. data tricky right now.
Exactly. So market direction, it feels like it's almost entirely coming from policy signals, headlines, that sort of thing.
It really is.
Yeah.
And it puts this unique sort of pressure test on stability. If you're trying to figure out where the real market energy is coming from, you got to look across the Pacific.
Right. U.S.-China trade.
That's the core tension, yeah.
Yeah.
Specifically, how global assets are trying to balance this very firm tariff threat, the hard deadline, with what looks like a surprisingly constructive diplomatic track running alongside it.
So it's like the playbook split, you've got negotiations happening, but also this looming deadline.
Precisely. And that's why you see FX kind of marking time consolidating. Commodities, too, stuck in that push and pull between demand questions and geopolitical risk.
Okay, so let's dig into the specific signals then. What's defining this kind of strange mix of stability and uncertainty for everyone listening?
Well, what's interesting is how much political clarity is actually coming from overseas, even while the economic picture feels a bit, constrained. Let's maybe start in Asia. That gave us some structure overnight.
Good idea. Let's look at Japan first. We had that significant political news, the Diet vote confirming LDP leader Sanae Takaichi as the country's first female prime minister. That feels like a big deal for stability.
Well, absolutely. Domestically, it definitely adds political stability. But the key thing for markets is the economic implication, right? What does it mean for the Bank of Japan?
And their commentary is still cautious.
Very. Resolute, actually, about not pulling back accommodation too quickly. They're sticking to that very, very gradual normalization story.
Okay, so political clarity, yes, but the central bank's still holding back. How did the yen react to that mix? Did it just sit there?
Well, initially it edged a bit higher against the dollar, reflecting that stability. But then it gave back some of that gain pretty quickly as Tokyo equities rallied.
Ah, so the equity rally suggests investors are betting the loose policy wins out long term.
That seems to be the rate, yeah. Betting that the accommodative stance continues for a while longer.
And this sort of wait-and-see central bank posture, it's not just Japan, is it?
Not at all. It feels pretty global right now. You had ECB officials, Nagel included, basically reiterating that same stance. So the euro didn't really do much, stayed near its recent lows.
Okay. And China.
Same story there, really. The PBoC, the People's Bank of China, they left their main lending rates, the 1-year and 5-year loan prime rates, unchanged, just reinforcing that steady policy backdrop for the yuan.
Right, but here's the interesting bit, maybe a contradiction. China's actual data growth, industrial output, retail sales, it came in pretty solid, right? Met or even beat expectations.
Yeah, the macro backdrop looked firmer.
But despite that, the commodity currencies, the Antipodeans, Aussie, and Kiwi dollars, they underperformed. That seems counterintuitive.
It does, and it raises a really important point if you're tracking these global links. Why the weakness despite strong China data? Well, the sources we looked at point specifically to some soft domestic data coming out of New Zealand.
Okay.
And the Aussie dollar just seemed capped, couldn't really get going. So the takeaway here seems to be that right now, domestic monetary policy, local economic weakness, that's actually a stronger, more immediate driver for these risk currencies than strong trade data from China.
Got it. Domestic factors winning out for now. Meanwhile, the U.S. dollar just kind of held its ground.
Yeah, modest gains, but really tight ranges, just reflecting that ongoing uncertainty, mainly from those mixed U.S.-China signals we talked about.
Okay, let's pivot directly to that then.
Yeah.
The U.S.-China tightrope walk, because it feels like that's the main event driving sentiment.
It absolutely is. And Washington's strategy seems pretty clear now. They're using the credibility of that hard deadline, November 1st, to try and force some compromises, sector by sector. But they're also keeping up this public appearance of being open to talks.
Yeah, the hard line is definitely there. The president reaffirmed November 1st for more tariffs if there's no deal. And he was specific, wasn't he? Heavy-duty trucks, buses.
Right. 25% on trucks, 10% on buses, effective November 1st. That's very targeted pressure, designed to cause some pain.
But then, like you said, there's the other track. The president also saying China's been respectful, repeating he'll meet President Xi, talking about wanting soybean purchases back.
Exactly. And mentioning being prepared to address U.S. leverage points like aircraft sales.
Yeah.
So it's this parallel path. Targeted pressure, but also signaling where deals could be made. Targeted relief alongside the pressure.
And the diplomats are busy. Treasury Secretary Besant and Vice Premier He Lifeng had talks described as candid and constructive.
And they've got an in-person meeting lined up for this week.
Yeah.
That's a clear signal that, negotiations are still very much active. They haven't stalled, despite the tariff threats.
Okay, so that's the main focus. But Washington's also active on other trade fronts. It's not just China.
No, definitely not. Look at Nicaragua. They proposed duties up to 100% after a Section 301 probe and moved to suspend their benefits under CAFTA-DR, the Central America Free Trade Agreement.
So flexing muscles there, too, showing they'll enforce trade standards globally.
Right. But on the more positive side, you had Seoul mentioning better odds for a U.S.-Korea trade arrangement by the time APEC meets.
And maybe the most structurally important one, that new critical minerals pact between the U.S. and Australia.
Yeah, that's potentially huge for supply chain security, long term. It involves a big pledge, over $3 billion in the next 6 months, and this joint push on processing minerals, which also brings Japan into the picture.
So a clear effort to build alternative supply chains away from current dependencies.
A very concerted three-way effort, yeah.
And just to round out the global picture, even Europe's feeling these trade frictions, right? The Dutch situation with Nexperia.
Exactly.
Yeah.
The Dutch economy minister had to defend their security-based intervention at Nexperia, and apparently talks with Beijing are happening soon to try and cool things down over that specific case.
So it underlines that trade tension now isn't just about tariffs. It's about strategic assets, national security, technology.
Absolutely. And that thread, strategic friction bumping up against economic reality, that takes us right into commodities, doesn't it? Because those friction points, they're not just diplomatic noise. They feed directly into the demand picture.
Good point. So how are commodities digesting all this noise? Crude oil, for example, seems to have steadied a bit after being choppy.
Yeah, it has. And traders seem to be doing a balancing act. You've got the Middle East headlines, which normally cause a spike, right? But they're weighing that against two key things.
Which are?
One, the absence so far of any new major supply shocks from the region. And two, these persistent questions about global demand. Is growth going to hold up?
So the market's pricing the geopolitical risk more as a potential drag on future demand rather than an immediate supply cut.
That seems to be the way it's leaning right now, yeah. Less about immediate barrels lost, more about the potential hit to global consumption down the line.
Okay. What about gold? It came off those record highs.
It did ease back a bit, yeah. That run-up was partly fueled by increased hopes for rate cuts, which maybe faded slightly. But importantly, it's still finding support. That underlying policy uncertainty, the geopolitical stuff, it's keeping a firm floor under the price, even if that immediate fear has subsided a touch.
Right. And copper, often seen as Dr. Copper, the barometer of global health.
Kind of stuck, really. Range-bound. Even though we got those firmer numbers out of China, copper didn't really react much. It seems like it's waiting for clearer signals, maybe something concrete from China's ongoing party plenum about their next 5-year plan.
Okay. And you mentioned energy. There were a couple of specific points providing stability.
Yeah, just quickly for energy watchers, Kazakhstan gave an update saying that disruption at the Orenburg processing plant, it wasn't actually hitting their domestic supply, and they expect intake to resume soon, so contained.
That's helpful.
And Iraq flagged they're close to an agreement with Accelerate Energy to import U.S. gas. Again, not huge headline news, but these little things add up to show efforts are ongoing to secure reliable energy flows in specific markets.
Got it. Okay, let's broaden out to geopolitics more generally. What's the theme there? Things still tense, but maybe more about enforcement.
Yeah, fluid but contained might be a way to put it, and focused on enforcement or adherence to existing frameworks. So in the Middle East, you had Israel reporting Hamas ceasefire violations, launching some limited strikes, but then resuming enforcement of the truce.
And the whole Rafah crossing aid flow issue,
Yeah.
it's now tied to specific conditions.
Explicitly linked, yeah, to the return of additional hostages remains and basically sticking to the agreed term. So conditionality is key there.
What about U.S.-Russia?
Diplomacy is continuing, but maybe more at the staff level for now. There's a leader's call described as productive, but talk of a near-term Putin meeting seems to be fading a bit.
And any news on Zaporizhzhia, the nuclear plant?
Actually, yes, a small positive update from the IAEA. They said repairs to the off-site power lines have started under localized ceasefires. It's a quiet step, but important given the risks there.
Definitely. And elsewhere, still some low-level friction bubbling.
Seems so. China alleged a U.S. cyber attack on one of its state agencies. And U.S. officials are apparently weighing the pros and cons, the optics, of a potential meeting with North Korea's leader during an upcoming trip to Asia.
So these things remind us that even if they aren't driving huge market swings today, these political flashpoints are still very much active under the surface.
Exactly. So pulling it all together, what's the bottom line for you, the listener, trying to navigate this?
Well, the current mood is really one of consolidation. FX markets seem locked in these defined ranges.
Pricing in both sides of the coin. Yeah, pricing in those constructive U.S.-China talks happening, but also that November 1st tariff threat, which still feels credible. The market's basically just waiting for the next concrete action, the next verifiable step.
So what are the immediate things we should be watching for? What could potentially break these ranges?
Okay, near term. Keep an eye on the CPI inflation numbers coming out of Ottawa today, and also the UK's public sector borrowing figures. After that, look out for maybe a heavier run of central bank speakers. And then, crucially, any real movement, any concrete news on that Washington-Beijing trade track, especially as we get closer to November 1st.
Right. Which brings us to a final thought for you to chew on. Reflect on this contrast we've just walked through. On one hand, you've got real signs of political clarity. Japan's new PM, China keeping its benchmark rates steady. That feels stable. But right alongside that, you have this acute diplomatic friction, this volatility. Things like those potential 25% tariffs on trucks, that security intervention at Xperia in Europe, the whole push and pull over enforcing the Middle East truce.
It's quite the juxtaposition.
It is, and it suggests that, while the policy foundations might feel relatively steady for now, its geopolitical risk, without a doubt, that remains the most unpredictable, the most active variable really driving things in the markets right now.
That's the wild card, and we'll definitely be tracking how that plays out.
Thanks for diving up with us today. We'll catch you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.